All right, in this video today, I'm going to discuss how to figure out your DTI, also known as debt to income. Now, if you've gone out to get a loan lately, you probably have heard those terms from the loan broker or the mortgage broker. And a lot of people have trouble figuring out or even understanding what it is. So hopefully this video, I'm going to explain that in great detail so that you can understand it better. DTI, or also known as debt to income, is how much are your monthly debt obligations compared to the income that you make. And I'm going to use an example here. It's going to make it real easy to understand. So let's say that you make $65,000 per year. What I want you to do is grab a calculator and take that number, 65,000. I want you to times it by 0.75. And I'm doing that because I'm going to assume that you pay 25% of your taxes to the government. If you pay more or less, just substitute that number. But you take 65,000 times 0.75, that's going to give you $48,750 after taxes. Now, I want you to divide that by 12 because there's 12 months in a year. That's going to give you a number, $4,062. That's how much you make each month after taxes. Now I want you to times that number by 0.43, and that should give you $1,746. Now you know your DTI number. Why is that number so important? Because most of the banks out there have underwriting guidelines that say if a person's DTI, or debt to income, is over 43%, they will deny them no matter what on their loan. So even if you have an 850 credit score or the loan to value on what you're trying to purchase is really good, they still don't like your DTI to be over 43%. Now, there are some loans out there that will let you have a 50% DTI, but most of the banks are 43, so I like to just figure it out on that. Now that we know our DTI number of 1,746, what that means is all of your monthly obligations on your credit report, such as if you have a car payment on there, a credit card payment, maybe a student loan payment, you add all those payments up, you come up with a number, and then you have to add in the payment for the loan that you're trying to get. Okay? Once you get that number, if it's over 1746, you're unlikely to get approved for that loan. So what would you do in that instance? Two things. Lower your debt or increase your income. Either one of those things will work. You could pay off some credit cards, you could pay off your car note, get rid of that monthly obligation, and that'll make your debt lower, and it'll calculate a whole different way. If you found this video helpful, please click and subscribe to our other videos. We teach people anything from budgeting to building credit or repairing credit.